Hi there. Thank you for joining us today for Business 101. I'm Nathan DeBar with the Economic Alliance. The Economic Alliance is a nonprofit 501c3 that promotes economic development in the Okanogan County region through planning, research, and small business advising and development. Please visit the Economic Alliance website for more information and don't forget to follow us on social media to stay up to date with the team. The financial plan is a crucial component that outlines the financial projections of a business. It provides an overview of the company's financial health and helps investors understand the viability of the business. The financial plan section should include several key components, including sales forecasts, expense budgets, profit and loss statement, cash flow statements, and the balance sheet statement. To write the financial plan section, follow these steps. Study the market. Assess your costs. Determine your profit margin, set your price, monitor and adjust. Study the market. Research price points for similar products in the market. Customers have an inherent sense of fair product pricing within your sector, and you need to meet their expectations. If you plan to vary drastically from your competitor's price, there should be a clear reason for doing so. Assess your costs. On an ongoing basis, a business must cover both fixed and variable costs that go into making their product. Fixed costs include things like real estate leases, insurance payments, and annual taxes that some businesses owe to states regardless of income. Variable costs depend on the amount of products you manufacture. They include raw materials and labor costs. There may also be costs from the product development process that you need to pay down. These all combine to form your total cost. Once you have determined your total costs, you can add a profit margin to it. The profit margin is the amount of money you want to make on each product sold. It is usually expressed as a percentage of the total cost. Once you have determined your total cost and profit margin, you can set your price. Your price should be competitive with similar products in the market while covering your costs and providing a reasonable profit margin. Financial statements are written records that convey the business activities and the financial performance of a company. Financial statements are often audited by government agencies, accountants, and firms to ensure accuracy and for tax, financing, or investing purposes. The primary financial statements include the balance sheet, income statement, statement of cash flow, and statement of changes in equity. The balance sheet provides an overview of a company's assets, liabilities, and shareholders' equity as a snapshot in time. The date at the top of the balance sheet tells you when the snapshot was taken, which is generally the end of a reporting period. The income statement primarily focuses on a company's revenue and expenses during a particular period. Once expenses are subtracted from revenues, the statement produces a company's profit figure called net income. The statement of cash flow measures how well a company generates cash to pay its debt obligations, fund its operating expenses, and fund investments. The statement of changes in equity records how profits are retained within a company for future growth or distributed to external parties. Thank you for joining us for Business 101, brought to you by the Economic Alliance.